Let's get to today's market action, though, with our panel. Joining me now is Scott Wren of Wells Fargo Investment Institute and Dana D'Auria of Envestnet. It's great to have you both here. Dana, I'm going to start with you because it's been a week in which stocks have traded in a, I'd say, relatively tight range. Nonetheless, we're seeing gains. The S&P 500 is something like 1% from its record closing high not that long ago. The fact that we've seen this reigniting of equities, what is propelling it, even as we have seen the economic data start to slow down and so show some signs of stress?
Yeah, it is an interesting mixed picture here, right? And of course, coming off a day where we saw consumer sentiment is starting to flag, concerns about inflation probably having a lot to do with that. In fact, we know that pandemic savings have really dissipated at this point. So, what is holding up that consumer is, of course, the employment picture. But, the employment picture is still very strong by any measure. But, we did see unemployment tick up a bit. So some interesting mixed news. And yet, you're right, the market remains very resilient. So I think the answer is earnings season had quite a lot to do with it. Earnings season came in largely, pretty robust. And yes, you are seeing some where if they're not hitting the mark, they're kind of immediately punished by the market. But for the most part, earnings have been coming in robust, and we're looking ahead to, yearly estimates that are still pretty strong. So I think that's holding us up right now with the market.
Okay. Scott, how do you see this market, especially given the fact that we did get that University of Michigan consumer sentiment report this morning? It showed a sharp deterioration in confidence, but it also showed an upward shift in inflation. What matters more here?
Well, I think in the end, Morgan, it is going to be, inflation. Is it going to come off? And I think that, as we move to the end of the summer and into the fall and probably into 2025, we're going to see some sub 3% readings on CPI, and that's going to be a good thing. And that's probably going to allow the Fed to cut a couple of times this year. And I think the market's pretty confident that inflation, and it might take, it's taken longer than what a lot of people thought, but it is going to trend lower. And I think as far as the sentiment numbers this morning, and I don't think it's a big surprise that, you see gasoline prices high, you see grocery prices high. Sentiment oftentimes is pretty tied to gasoline prices. It's certainly been tied to inflation in this cycle. And we all know that consumers, what they say, U.S. consumers, what they say and what they do are two different things. And I think you can make the argument that if consumers are employed, they have money in their pocket, they're Americans, they're going to go out and spend money. So, we think the unemployment rate's going to probably crawl a little bit over 4% by the end of the year, which is, not anything disastrous or anything like that. But I think that just the thought of earnings hanging in here, the economy being better than a lot of people expected, and inflation, tracking lower, even with, a few things that have happened lately data-wise, that's what's really keeping this market buoyant.
It sounds like we're realizing the soft landing scenario based on what you're saying, if I can pull out that implication, Scott. Dana, the fact that we're seeing utilities, financials, materials, you even saw staples catch a bid this week. These were the best performing sectors on the week. And actually, tech was one of the worst performing sectors. What does that tell us about the recent rebound we've seen in this market?
It could be a few things. There's sort of some longer term impacts here. There's obviously the narrative now, higher for longer. You certainly have the Fed out there trying to, instill the message that they aren't going to move that fast to cut rates, whether that transpires or not. We've got a long way to go, right? First rate cut now expected in November. So a lot of data that needs to come in between now and then to see where that actually goes. But, when you look at something like tech, where it's longer dated, a lot of the tech story, not entirely, of course, there's a mosaic here, but AI, of course, is a big impact on the tech story. Not a lot of data that people can actually put into models at this point around how quickly AI is really going to bounce. So, movements and things like, higher for longer, and these could be longer dated cash flows. I think you have kind of secular impacts like that. And then you have short term where, the market has broadened out. There's an argument to be made for just there is resiliency in the economy. And so you should expect a broadening out in what participates.